These are 6 uncomfortable retirement truths that we all need to hear. And the first one is, unfortunately, for most of us, it'll never feel like we have enough money. I'd say well over 90% of my clients never feel emotionally like they have enough money. Intellectually, in their mind, they're like, okay, I know I'm okay. But emotionally, it'll never feel like you have enough. And if you think that I might be wrong on this one, first off, I've been a financial advisor for 20 years. But more importantly, there's a study that was done by Boston College. And they went and they surveyed their endowment donors. So some of their wealthiest alums, some of their wealthiest contributors to Boston College. And one of the questions they asked was, do you feel like you have enough? And this, do you feel financially secure, was the question. And this was to a group whose average net worth was just under $80 million. And you know what the answer was? Unfortunately, the answer was no. And when asked, how much money would you need to feel financially secure? Almost across the board, it was double of what they have. And that agrees with my experience as well. If you have 1 million, boy, having 2 million would feel better. If you have 2, 4 would feel better. If you have 4, you're probably going to want to have 10. So that's uncomfortable truth number 1. Uncomfortable truth number 2 is because few of us have it anymore, but that is just the power of a pension. The power of somebody else being responsible for the investment returns. Somebody else is on the hook to make sure that you always get that monthly check. Now, for many of us, our parents had pensions, or our grandparents had pensions, and we're one of the first generations in the United States where that's no longer true. And we're just now coming to grips with just how valuable a pension can be. You have a lot of flexibility if you have a pension, even if it's not as much as what you want it to be. At least you have that guaranteed income coming in. So you have a lot of flexibility if you have a pension. You also have a lot of flexibility if you were able to pay off all your debts before you retire. Boy, you can have a good retirement if you have no debts and you have that pension coming in. And I'm not saying you need that, but there is this sense of uncertainty that comes from the lack of a pension and also comes from the pressure of having debt. So if I did a 2x2 matrix and had debt or no debts and pension or no pension, you want to be in the upper right-hand corner with pension and no debt. And even if you have a pension and you have debt, you have quite a bit more flexibility than if you didn't have that pension. And likewise, if you have no debts but no pension, you have quite a bit more flexibility. So that's uncomfortable. Truth number 2 is just how important it is to have that dependable income, which few of us do. And if we don't have that, how much more important it is to look at our debts and say, what can we do to pay off our debts earlier so we have that freedom? Okay, number 3. Number 3 is, unfortunately, $500 a month or $1,000 a month difference can make a big impact, can have a big impact on your financial plan. If you go to your financial advisor and you say, I want to spend $7,000 a month just to make up a number, and your financial advisor runs the numbers and says, okay, yeah, you have a 95, 97, 90% likelihood of success. If instead of spending that $7,000, you end up spending $8,000, you can dramatically impact the results. So a financial plan is super sensitive to how much somebody says that they want to be able to spend in retirement on a monthly basis. Now, if you have a couple months where you splurge and you buy something nice and you spend more money, is that going to move the needle? Probably not. It depends on how big the thing is that you buy. But in general, if you're on budget and you have a couple months here and there where you spend more, it's probably not going to move the needle. But also, in general, if you spend more than you told your financial advisor when you put together the plan, or if you're doing it yourself, when you put together the plan yourself, it can have a big impact. So just like when our health changes, we go see our doctor and we say, hey, like for instance, I like to run 5Ks, and they're not too hard for me to run, right? But if all of a sudden running a 5K became difficult physically, I should tell my doctor that. And likewise, you should tell your financial advisor if you find yourself spending more money than what you thought you were going to. Okay, let's keep moving on. Number 4, unfortunately, even when we retire, we still have to put up with the ups and downs of the stock market. It's really important that we beat inflation when we retire. Otherwise, eventually the purchasing power of our money goes down, right? We've heard this, the power of compounding, how your money starts working harder for you than you are. And Einstein said, the eighth wonder of the world is compounding on your investments. And I agree with that, but I think it's important that compounding cuts both ways. If you get a rate of return greater than inflation, then your money is growing stronger and working harder for you each year. But if you start growing at a rate lower than inflation, then it's reverse compounding and it starts working against you even more quickly. So that's the fourth one, is we have to stay invested, and unfortunately the volatility of the stock market, which is number 5, when we're invested, volatility, the ups and downs of the stock market, that is a feature of the stock market. That is not a bug of the stock market. So it's just the nature of being invested in the stock market. So let's say you retire, and none of this is financial advice. I don't know your situation. I encourage you to work with an accountant or a fiduciary financial advisor that knows your situation. But if you're in the stock market, let's say you're 60% in the stock market and 40% in bonds, there's no way to avoid that volatility. If you want that security, that comes with risk-free investments, and those risk-free investments generally don't keep up with inflation. So just be careful there. And I also want you to, when we're talking about asset allocation, instead of thinking, like earlier I said, 60% in the stock market, 40% in bonds. When it comes to thinking about your bond allocation, I want you to think of how many years of living expenses could I fund from the bonds in my portfolio? Because because we can't eliminate the stock market volatility, right? That's just what it does. That's a factor out of our control. But what we can do is we can set up our portfolio where the impact on us, the anguish, the mental anxiety that it causes us is minimized. And one way to do that is to think, you know what, I don't have to sell anything in the stock market. I have plenty of time for the stock market to come back because I have 3 years, 5 years, 7 years worth of bonds. Okay, next, unfortunately, and related to this, number 5. Number 5 is, unfortunately, when we retire, the way we feel about risk, the pain of that volatility that I talked about earlier, that is going to increase. And for most of us, it's going to increase substantially. So when you were working and you were putting money into your savings account, it's not a big, if the market goes up, the market goes down, you're still putting money in and you have years until you need to touch it, right? But once you retire, and that's your entire nest egg, and this is really a key point, the way you feel about that nest egg going down in value is going to feel a lot different than when it was a retirement account going down in value. Once it's all the money you have in the world, that account going down gets your attention. So that's another caution, and you need to know this ahead of time, because if you're over allocated to stocks, if you're like, you know what, right now I can barely withstand the pressure and the pain of the market volatility, and you're not retired, then probably, and again, it's not financial advice, but work with a professional, because that might be too much risk for you. Because again, the way risk feels, the pain of loss is going to increase when we retire. Okay, and number 6, transitions are hard. And as much as you might be looking forward to retiring and kind of hanging up your cleats and saying, okay, I did it. I ran my 40 laps, I did my 40 years or 30 years or 20 years, whatever. And that feels great. But the transition is difficult for most people. I say about 3/4 of my clients have challenges with the transition. Now that doesn't, and I should say that once you get on the other side of that transition, people look back and very few people say, you know what, I think I made a mistake, I shouldn't have retired. That does happen, but very, very seldom. But the secret is getting to the other side of the transition. There's 4 phases that you go through in retirement. I'll just quickly name them off, but it's outside of the scope of this video to go deeply. But the first phase is it feels like vacation, and make that last as long as you can. The next phase is where you feel a little lost. Many of the things, many of the routines that you had, many of the friends that you had through work, those for the most part are gone now, and it's okay to grieve those losses. And the third phase is kind of iterating and finding your new purpose and your new passions. And then your final one is you've got your new purpose. You have transitioned into your new purpose, and you look back and say, boy, I should have done this a lot earlier. But there is that valley. There are phases 2 and 3. And the one that I'll leave you with here that I think is really important is that by far our health is much more important than our wealth. Right? If you have wealth but you don't have your health, you're not going to enjoy your retirement. So invest the time, invest the money, invest the effort to stay as healthy as you can. We can only do so much, and then our genetics kick in, but do what you can so that you can have as healthy of a retirement, so that you can enjoy the journey as long as possible. And speaking of enjoying the journey, I made this video up here, which are 7 things that I want you to think about stop doing in your 50s, your 40s and 50s, in order to enjoy the journey up until retirement. Thanks for watching this video, and I'll see you in there. And if you're curious, if you've made it this far, this is my windbreaker to keep the sound of the wind off. So if it looks goofy, that's what it's for. Again, what was it? 7 things to stop doing in your 50s to enjoy your journey. Thanks again for watching and putting up with my silly windbreaker here for my microphone. Bye-bye.